Shannon, will you call to order?
Trustee Rubin,
Yes.
trustee Hallwax.
Yes.
Trustee Mealopoulos.
All right. We have all of us going forward. At this moment, it's time for public comment. If anyone would like to make a comment, in which case I have a little spiel to read. But if no one is making a comment, I'll save us all for 4 minutes. All right, hearing none, seeing none. Can I get a motion with regard to the monthly minutes, unless someone has a comment? Second, all in favor? Aye, they're approved, which brings us to the review of our financials for this month.
Good evening. I'm going to go through the April treasurer's report with the fund highlights. And then we will go through the CIP updates. And then tonight we have PMTA here this evening to review and discuss the Village of Glencoe's investment portfolio. So moving on to the general fund. All right, starting the general fund for the property taxes. Property taxes are less than prior year by $247,000 and at 45.3% of budget. With that second installment tax receipt approved back to 2025, that makes it less than prior year by $2.4 million and at 29.3% of budget. Disbursements, all the disbursements that we received after January 1, we're still waiting for the Cook County reporting to be updated. And so we are assuming that January, February receipts and some of March may be attributable back to 2025. But we did receive 4.4 million in April that we believe is related to the first installment for 26.
We still just don't know.
We don't know. And I actually just talked to somebody else last week.
Fathom how we get the day-to-day square and said we got all that we expected. How they operate.
Everything
This
is
is progress on the second, on the new year tax bills, because we are getting edits from them, so they are working on it.
Okay.
But my suspicion, I think they have a couple more months before they'll be able to true all this up.
So the less by 247 or less than we were anticipating takes into account the full slug of money we got. We just don't know exactly how to allocate it. So that number might go up or down, depending on how it gets allocated. Okay, thank you.
And then, so moving on to state income tax, it's more than prior year by $27,000 and at 34.8% of budget. Our target is 33.3% for this month. Sales tax is more than prior year by $79,000, where this is for January sales, and we're at 32.5% of budget, so pretty much right on target. This month we had a lot of different revenues coming in higher than the prior year and monthly budget. That includes sales tax, Illinois income tax, building permits, use tax, parking fees, personal property tax replacement, sewer charges, and E911 surcharges, which is good news. Moving on to the general fund expenditures, we are more than prior year and at 31.2% of budget. Our annual revenue projection, revenue only performance versus the budget. Currently the general fund is at 3.7 million, but that's with the 2025 property tax receipts. If you remove those, we're at $1.5 million without those receipts. Looking at the surplus deficit of our expenses and revenues, general fund is at $736,000. And if you remove those tax receipts from 25, we're showing a deficit of $1.4 million. And we had that planned drawdown of 2.2 for the capital expenditures out of the general fund.
And again, is that that's a more timing issue than anything else?
Yes, timing, and also we have a number of revenues that are actually projecting to be higher than what we budgeted right now. And then our fund reserve at month end is 15.9 million and at 54.3%. For the water fund, volumetric water is higher than prior year. We're ahead by $44,000 and at 19.7% of budget. Just a reminder that as we see irrigation start happening and those quarterly bills start coming out as into summer, we will start seeing that percentage get higher because there's more water usage at that time. We're still seeing water usage from winter time currently. Fixed charge revenue is higher than prior year at 27.2% of budget and ahead by $9,000. And then our expenditures are higher than prior year, but right on target at 31.2% of budget. Oh, excuse me, less than, pardon me. And at 24.4% of budget. So revenue only, we are looking at the water fund being ahead by $86,000. When we look at the expenditures versus revenues, the water fund is at $2.7 million. And then that's due to the planned bond proceeds that we'll be issuing this year. And we did have a planned drawdown of 1.8 million for capital expenditures. Fund reserves at month end are 2.6 million and at 46%. With that, I will turn it over to Stella to go through the health fund financials.
Thank you. So April was the second wettest month on record. With over 8 inches of rain and below average temperatures. Record keeping, you know, probably, yeah.
The year's record.
The good news is we did have some warm weather that landed perfectly on the weekend days. So we capitalized on that and we were able to achieve 34% over our revenue budget. On the days that it was not ideal out, we did save on payroll. So we saved 14% on our payroll budget and we're over 34% on our revenue budget. So the timing on the good days was pretty great for us. Clubhouse update. It is changing every single day and looking much better every single day. The precast topping was poured and exterior patio concrete was poured, so you can actually see what the patio was going to look like, and it looks beautiful. The wall framing is 75% complete. The flat roofing work is 80% complete. Window framing installation has begun, so you can start seeing large windows throughout the building. And we are on a very aggressive schedule with all of the trades in there. We're trying to stay on target, but it is a very aggressive schedule, just to keep that in mind. And then I just wanted to mention the Glencoe Historical Society was very kind to work with us. We thought it would be a great idea to incorporate some historic Glencoe photos from the 20s and 30s in conjunction with when the golf club was established. So we're grateful that they found quite a few pictures, and they unearthed a 1931 aerial shot of the golf course. It just shows the golf course, and there's nothing around it except forest in every direction. So it's gonna really look great. We're gonna have that in the clubhouse.
My house was 1955, so.
Yeah.
I would say Stella and I did a video today that we'll release in the next couple of weeks on social media, doing an interior tour of the building. It is really, really, really cool. And it's coming together incredibly well. The placement on the site is so, it's just really well situated. The event lawn space that I never really had a good sense of how large it's going to be. It's going to be very large. It's going to really provide some fantastic spaces for people to enjoy when it's ready. And it was nice to be able to stand on that terrace today and kind of envision what it'll be like at some point, being able to have a meal out there and watch the sunset. So it will be very busy. It will be one of the prettiest spots in town when it's done, without a doubt.
And then we have 4 photos to share with you this evening of the clubhouse. So if you'd like to give us some commentary on what's going on.
Yep. So that is the view of the clubhouse looking from the west to the east. So that's showing the full patio. Seat for 73 people out there. It looks very different today.
Yeah, I'm gonna say this is all paved now. the entire terrace that wasn't paved
Right,
when that
and
picture
they
was taken.
continue to do a lot of site work on the stones, and the stonework is phenomenal, it's so pretty. This is the main entrance, this is where you'll walk in, you can see the ramp for the carts on the left-hand side, it's kind of hard to see. And this is the pro shop on the left-hand side, which will be having views of the new first tee. And then here's just another view that is the private dining space. So that has windows facing north and west. That is going to be
Yeah.
a well sought after space. It is going to be gorgeous in there. Floor to ceiling windows and views in both directions. It's going to be beautiful.
So this picture was May 16th, so that's Saturday. Today, we were out there, all the framing is in place for all the windows, all the way around the whole west and north side of the walls of the building. So yeah, it's cruising along.
And there's the concrete. So that's the patio that was poured.
Aerial pictures done with drones.
Yes, Caesar's our pilot. He has
He's
some-
done some cool stuff on social media, I'm sure Sam.
Thank you so much for sharing that. Moving on. Sorry, that's a hard thing to follow this evening. So our debt service capital fund and MFT are right on target. With 23.7% of budget for debt service, capital projects being 12.4% of budget. We're really gonna see this start ramping up in the next few months. There's a lot of projects that are kicking off and it's starting, and we'll see those invoices being paid. And then MFT, we still have only 2.5% of budget, but there is a few items that are coming up that Monica will be talking about. And then our pension funds are right on target at 34% for police and 33.4% for fire. Personnel costs, again, still full-time salary, cost of living increases, and filling vacant positions has increased the year-over-year personnel costs. Just one update, we only have one PSO vacancy. And so we continue to try to fill that position. I know they did have a round of interviews at the end of April, and so hopefully we'll hear some good news from that process. Moving on to economic indicators and some other updates. We still have the Middle East conflict expected to impact our commodity costs. The one major one we're all seeing is fuel costs have risen 12.8% from March of 26, so just from this year to April. That's what they've risen by, and then 29.4% compared to April of 2025. So that's a very large increase. Computer hardware prices continue to rise sharply. I have a very detailed update from the IT director, Matt, who's not here this evening. Driven by global RAM memory shortages, fueled by AI data center growth. There's a shortage there, and then we have increased refresh demand tied to the Windows 10 end of life process. And then Dell, Lenovo, HP, Acer, and Asus have all warned of 15 to 20% price increases on their systems that are shipping in 2026. And saying that that might persist into 2027. And they've also said that they've already observed significant quote increases from both CDW and Dell. And so in response to that, they're going to start evaluating lower cost standard laptop models, and then procure about 10 to 15 machines to address immediate needs and also build a replacement stock so that they won't avoid those future price increases. So you can just see that's one significant area that's really seeing this cost increase.
One of the statistics that we shared when we were talking earlier this week is that every processor that is planned to be built in the next 3 years is already spoken for. So if you think about that from the standpoint of every processor produced in the United States and around the world is already spoken for, which means the only ones that will be left are the cast-offs. So it's going to be a seller's market.
think he said his quote for replacing laptops went from $12,000 a few months ago up to 19,000. Just like a week or two ago, so it's escalating.
Can you buy direct from computer companies or we have vendors? Is it work?
CDW is typically, I mean, these are all government contracts, so they're already kind of pre-bid, if you will. We could probably try. I think the problem is if you don't have a relationship, you are gonna get to the bottom of the list. So maintaining those relationships actually is helpful in actually acquiring what you're seeking to get.
And since Matt has started, we've established a relationship with CDW government with their arm, so hopefully we'll be able to leverage that in the future.
Is the cost, I realize we need to do it that way, is the cost of the laptop significantly more than the comparable private sector laptop, or is it just more chock full and faster and better?
Depends on the use. We have different laptops for different purposes. So if you're replacing laptops for the detectives, for example, they need more powerful, more storage, faster, more rugged than someone that might be working in finance and utility billing. So we try to right size the computer to the use. So it depends on that, but we don't have super government computers.
Well,
Programs that are expensive that are loaded on there
Yes,
are not.
yes. No, and that's a good question.
For
because
security.
That is something that our IT team is looking at is streamlining, like preloading some of the laptops. If they come already ready to go with all of the applications that you need, there is an upcharge to that. So right now we do it in-house. But that was something they were looking at from an efficiency means, but now might not be the time to do that in terms of cost.
Yeah, we're not going to avoid the higher costs. We're only going to delay, but whatever we can do, these things aren't going down in price anytime soon. Unfortunately, I mean, just looking at everything that's been happening, this is the one area, the future increases in costs is the thing that's worrying me the most right now about any of this, because otherwise, let's face it, we're in good shape. But the bond market today, that's just, it's just.
And we are looking to, like, to answer your question, we're to like different brands of computer, because we typically become a Dell shop, but those prices are rising faster than some of the other brands. So I know that's something else they're exploring. It's not ideal to have kind of a mixed use, but that might have to be where we're going to transition.
But everything I'm hearing, like real estate in the private sector, the build costs and everything else, I mean, everything is just constantly going up, labor shortages, adding to that. There's nothing deflation. Yeah.
We do want to make sure we're getting what we can, like the best of what we can
Right.
for our staff too.
Right.
So we're not trying to, I'm not trying to say we
Right.
need to cut corners anymore, but let's make sure we just are smart.
The best price for what we need.
Exactly.
Yeah.
Right.
So no, you're fine. So with that, just commodities are coming a little higher than what we expected, 36.8% of budget. Again, our target's 33.3. So we'll watch that closely to see how that's increasing in the future. And then contractual services are higher than the prior year and at 28.2% of budget. And we still are on target for our audit update. We received our draft audit about 2 weeks ago, and we'll get our final draft hopefully this Friday after we return some comments to them tomorrow. Everything's looking really good. And so that's great news. And so we'll have that presentation in June for the finance committee. We will have a auditor from, or somebody from the management team of Lauterbach and Amon at the finance committee and the board meeting in June. And then,
And the actuaries.
oh, and for the actuaries.
It's gonna be a
Yes.
party.
Yes,
This is next month.
yes, next month.
So many accountants.
So it sounds like a long meeting.
No, don't call an actuary an accountant.
No, I know, you're right, all right.
Get slapped. I know.
And so with that, I'm gonna turn it over to Nikki to talk about the upcoming bond issuances.
in other exciting news, we do have a bond issue coming up next month. We've gone out with the preliminary official statement, so our financial advisors are taking the bonds to market. We'll be doing a competitive sale the night of the board meeting of June 18th, how we've done in the past. The board will have the option to accept or deny the results of the sale. We have a ratings call next week on Wednesday, May 27th. So we will certainly keep you posted on what we hear from that as soon as we hear back from them. We are recommending splitting the series into two. Now, because the library had a successful referendum, we will be borrowing the first installment of their bonds in June for essentially for soft costs, for their engineering, their architectural fees to help expedite their process. Nothing's getting cheaper, to your point. Their project's not going to get any cheaper. So they're looking to move this along quickly. So also on the agenda Thursday night is a reimbursement resolution to allow them to reimburse themselves from bond proceeds for anything that they're incurring now. So they are moving forward with some of their soft costs. So I'm recommending splitting the series between Series A, Series B. We'll take them both out to market at the same time. Series A will be the $10 million to fund our capital projects for the next 3 years. That was what we had talked about during the budget process. And Series B will be 3.9 million, which will be the first installment for the library series. It does cost a little bit more to split out the series. It's about $20,000 in closing costs. So it is something I wanted to bring before you just to kind of get your temperature on how you feel about that. But I do think it's beneficial to split out the village issue from the library issue. There'll be call options on both bonds. So if we decide we want to refinance them, we'll have options, but at least those two will be separated, be easier to track. Any thoughts or concerns about that recommendation? On an issue this size is not that much.
Even though we said that if the does the library board have to make their decision on bonds or so I'm saying like
From what perspective?
so we're issuing the bonds for them. So
Correct.
just keeping it separate. It's unlikely that we would refinance one, not the other.
Correct.
Right.
Correct.
So I mean,
On the other hand, it might help the reporting overall costs and talking about it with the public, and if there's a certain simplicity in keeping them separate that might help. You guys are saying.
The other, I'm sorry, Phil's reminding me, the other issue is that we were proposing the 10 million to go out 20 years for our capital improvements, but extending the library issue out longer. So this 4 million might be up to 30 years, or it could be 20 years. I wanted to kind of get your thought on that. By splitting it into 2 installments, we could do different terms on each one of them. We did talk to the library board president. He did defer to the village board because we are the ones that are financing on it, and said, you know, we'll probably makes sense to go with a longer duration.
I think the majority
On this board.
of this cost or these bonds are really more soft costs. So it's going to be architectural fees. It's going to be the kind of the beginning of the building process. It's possible, if you want to look at it this way, you know, the total the second issuance, which is, I can't remember the timing of, it's beginning of 27.
They're optimistically targeting this fall, but realistically will likely be 27.
Yeah.
Yeah.
You know, that one will be much more hard costs, if you will. So if that may be a consideration too, is that for the soft costs, maybe we want a shorter term, for the hard costs, maybe a longer. But this is the benefit of being home rule, is that we aren't tied to that 20-year term any longer. We have the ability to spread it out. And I think particularly with an investment the scale of the library, there is some value in thinking about it and a bit of longer term impact.
So
What is
when we did the bond, when we did home rule, we said to our residents, so one of the reasons we're doing this is when we have really long life assets, like these buildings that are gonna be there forever, it's fairer to the residents to stretch it out longer. So, and likewise, we wouldn't want to stretch out the soft costs, which are, happening now. But I think we should. We told our residents we were going to do it, and that their tax bill would be a little bit lower today than somebody that moves into the village in 20 years is still getting the benefit of they'll pay part.
The interest rate will
Except that the long end's getting hammered.
My question.
with the shorter
Long
period.
end's getting hammered.
That was my question is, are we, I just want to make sure we're not funding into an anomaly in the rate spreads. I don't know what I'm talking about. He does. I don't. You guys do.
When do we have to decide? Because we can certainly answer this presentation, we can think about this because
I don't
the curve's gotten pretty steep.
Does the
Just
We
recently.
can still restructure up to the night of the bonds, but we probably need direction on this one.
I don't remember though if I'm sorry, because we've never had the option of different terms. This is really our first bond issuance where we do. So it's been a bit for me since I've been in a bond sale where we have that. Do we have the alternative of if it's 20, if it's 30 for that series? Would the banks bid at either a 20 or a 30?
We have to,
That you
we have to
select.
go to bid with what?
So you can't have an alternate. Okay.
You can restructure it. The way the bonds work, there's series of terms that are going to be redeemed each year, right? But it's really the maximum how far we want to go out. And ultimately, you guys can speak to bond spreads right now on a 30-year versus 20-year. The last time we talked to our financial advisor about it, the difference was negligible, but I also know the market's kind of wild.
Yeah, I mean, it's continuing to widen for sure. So I think that is something to look at.
We would have, I guess, sorry, this is maybe an elementary question on this though. We issued at a 20-year term, we would have some ability to restructure those at a future date if the village board at that time decided to do so.
Yes.
Taking a look at our entire debt profile and restructuring some of those issuances.
And you could always shorten it and refinance it like a mortgage, right? So
Can you lengthen
both
it?
of our bonds, this home rule unit, we should be able.
Yeah, so
From both of the bond series will have call options in them. So there will be likely 10 years out, we'll have the option that we could call the bonds and refinance if we need to. Which in a market like this is worth paying a little bit more for the call option. It's negligible in terms of basis points. And typically we structure all of our bonds issues that way, just because we don't know what the
Right.
future's going to hold.
So, and in theory, if we get the bid and we freak out, we could say no.
Yes.
correct.
Yes. We always have the option of declining and going out to bid at a different time.
Do you have an idea what the dollar amount difference would be in terms of interest for either option? You say negligible rate, what does that mean in dollars?
I think the 20 and the 30-year yield are actually kind of close, but they just both went a lot higher than the last 6 weeks.
This would be paying.
No, actually, the 30-year looks like it's slightly lower than the 20 right now.
But dollar in terms of what we said.
Yeah, and explain that
Explain
in any
that.
They just don't trade as much. I mean, nobody goes on that duration anymore. I mean, past time,
Too long.
you don't really.
Yeah.
And that's something that's something to consider as well. What you just hit on is the longer term bonds can sometimes be harder to market.
which will cost us more, therefore.
You won't see as
We
much
see that in the
activity
spread
on
over
bonds, yeah.
treasury, so and
Yeah.
then we might say, you're not paying an extra 20 basis points to go 30.
Well.
Would we have to decide on this for Thursday? This
No.
Thursday? This will
Bond
be
sale won't be until the 18th.
Of June, so next month. This will be,
Okay.
the board will be,
Yeah, we can talk about it some more.
well, I would say
Right here.
we do need some
Need some
direction
direction.
as to how you feel about a 20 or a 30, because that's what we have to put into the,
Well, inherently, even if it was exactly the same interest rate, if you're spreading it out to 30, ultimately we're paying more interest than gross. But we're also making smaller principal payments. And consequently, from the standpoint of, do our taxpayers really care about any of the discussion we just had? Or do they only care about what their real estate tax bill is when they have to pay it? And I'm guessing it's mostly the latter. And consequently, maybe it makes sense to do what your instincts were, which is to look at the 30 unless, because the 30 is softer, there's a significant anomaly between a 30 and a 20. That's, where do you come up? What do you think?
I think to Howard's point, we did talk about having the ability to have a higher duration. You know,
Yeah.
To match the life of the investments. That would be where my default option would be. Again, maybe we get some guidance about what liquidity is like. And I mean, treasuries are trading roughly flat. We have to pay a lot more to get the 30 than I think you do the 20 and then you plan on restructuring. But when it's callable, and we have to hold it for 10 years before it's callable, or
We can structure the call option. We have some flexibility, but what we've typically done is 10 years.
thoughts?
It's a 20-year option for this small.
Our financial advisor prepared both of these at 20 years in the preliminary official statement. That doesn't mean it holds us to that, but that was what they were thinking. If that's helpful to you at all.
yeah, I mean, I would say these two issuances or these two series, we probably will be fine at a 20 if we want to approach it that way. As I said before, when we talk about the next issuance, which will be what, about $13.5 million for the library, that will be the majority of the hard costs for the physical building and everything going into it. You may want to look at 30 as that alternative. The market may shift a little bit by that point in time. But maybe we stick with 20s for now.
And to be fair, just because we have unrolled, so we could, it's things they still expect us to make. Yeah, I mean,
This seems like the time to do, I mean, we're looking at soft costs and, under that circumstance, yes, our part is not soft costs, but the library's is. Yeah, I would say 20 now and look to see whether it would make sense to do the longer one when we're doing that building, which we hope will last as long as the first one did.
It sounds like the answer is,
We will keep you posted on how the bond rating call goes next Wednesday. The library will be participating in both their executive director and their village president as well. So they'll be, I'm sorry, I didn't say. Oh, I apologize, the library board president. So we'll keep you posted. You should hear back within a few days of the call. So
Yeah, they're usually pretty efficient at that. Those calls are, I would say, we get incredibly well prepared for those calls because Nikki is incredibly well prepared for those calls. But we all sit around the table and they're quite nerve-wracking and anxiety inducing. Because, you know, we are very conscious of wanting to ensure that the AAA stays AAA. And so there's a lot of work that goes into that effort. Obviously, the work that you're doing in this committee and the work that the village board does generally, but it's also a ton of work by Nikki and her team. So we're well served from that standpoint.
Do we think we have a stronger hand automatically because we're home rule?
Yes.
For sure.
So there's that.
Yes.
And, you know,
Yeah.
the flip side is that means they were sure they could get their money,
Yeah.
but from our point of view, they were always gonna be able to get their money and we'd like to pay less.
Absolutely.
Just wanted to add, if we have to, I'm sure we'll have to come up with an idea, like which way to go in the future. I think it would be beneficial to actually have like concrete dollar amounts for each option. You know, like we did when we were going out, we said, okay, this would be the equivalent of $150 for, I don't know, $100,000 valuation per house, you know, per bill. I think it would be helpful to have both 20, if we know a rate, hypothetically.
Concrete makes me a little nervous.
Yeah, well, not concrete, but like a
Give you
general,
estimates.
general estimate, all right, this means this much per month for this type of house, and for the 20-year option, and then for the 30-year option, this much per year. And then what our interest total, if we amortize the whole loan, would just be, I think, a little bit helpful for us, for me, to understand and then provide some clearer guidance.
And we can present that with the bond sale as well. We can present it that way, so you can see the impact when you approve it that night too.
But
Or not,
Yeah.
on the
to your-
contrary.
to your comment, I think, particularly now that we have more flexibility in how our terms can be structured, we can take a different approach to presenting the information to you, where we build out perhaps a few different scenarios with our financial advisors, where we can try, you know, making assumptions about rates and things like that. We can give you a bit more comparable clarity on that. What's the difference between a 20 and a 30-year issuance?
Something about the,
Yeah.
what does that actually mean?
Yes. All of that information is certainly interesting and potentially useful. I want to make sure, though, that that last point you just made makes me worry that we may be providing information that is somewhat misleading because of the point of you buy a house, get your mortgage, figure out how much it's going to cost you, and you think about the term and the rates and everything else, and overall what it's going to cost. Whereas somebody coming into the community that's paying a real estate tax bill right now may be moving in 2 years or 10 years, and so they're not going to pay it.
Oh, I understand, yes.
So, because otherwise you're always going to, you know, look at, well, the overall cost is so much less if we issue 5-year bonds.
Yeah.
You know, I just want to make sure that that presentation doesn't, I don't want to hide the total cost, but I also don't want people to start analyzing it as though everyone in the room is going to be still paying their real estate tax in Glencoe in 30 years. It'd be lovely to think we are. I'm looking at how
Probably
many,
not.
Never know.
No,
but yeah,
I understand, yeah.
that's only if we get
Just in
lucky.
general.
It's good feedback all around, so we'll modify the presentation in June. And then when we talk about this again, we'll talk a little bit more. Okay. All right, I think, are there any other questions on the bond issue before we move forward? Okay.
Well, one of the things I do think, I'm sorry, in connection with the bond issue, remember the old graphs that we used to have in our packet that showed when bonds were going up and bonds were coming off and
Oh, yes, okay,
That
I thought
those-
you were talking
I
about rolling
think-
12
I
cents per
think,
second.
no.
Okay.
I think that some presentation about that so that we can see it visually and everybody can get that
Yes, we talked
is,
about
would
that.
be helpful to folks.
Financial forecast will be here before you know it, but we'll be talking about that sooner,
Okay.
so.
Thank you.
Anything else on bonds? Okay, I think we're ready to move on to the CIP update.
March and
All right, so for the month of May, we're seeking board approval on 3 CIP items. The first one is the pedestrian crossing improvements at Harbor and Green Bay Road. This project is funded through MFT funds.
We went out to bid for a second time. We did receive a response from Mead, who does provide maintenance on our signals, right now. And their response was, within our budget. So happy with the response, and we should be able to get to it this year. The second project is for bridge maintenance, construction and engineering. This was originally planned and scoped as the Hazel and Lakewood bridges. We are slightly modifying that scope to be the Hazel and Scott bridges. At the end of last year, we completed our biannual bridge inspections with IDOT. And with that, it just reprioritized what we want to focus on this year. So we will be focusing on Hazel and Scott for the engineering design and some spot repairs on Scott and Bridge.
Is that because Lakewood is in better shape or Scott is in worse shape?
I would say, well, I think the repairs that we're looking to make on Scott just had more urgency than what we wanted to be focusing on. That also is within our planned budget as well. And then the third item that we're seeking approval on is for the public safety rescue boat, and I'm going to turn it over to Chief Cochran.
Ahoy, everyone, shiver me timbers, prepare to batten down hatches as we move forward, full steam ahead. So I
happened once before and I should have prepared myself. Well,
I may have prepared 2 pages of nautical terms. That's occasion. Not.
curse you, AI.
But all kidding aside, just for discussion, just to bring it up now, but really for discussion is the point for the traditional board meeting. As you know, previously as part of our budget, 2026 budget, CIP, we were replacing the 2008 pattern Zumrold boat, which has by far exceeded its lifetime. And so we spec'd out a particular boat that would meet the need for both operating in Lake Michigan and also in inland waters. Those specific details gave us a price point of $95,000, which was budgeted. Based on conversation, we were hoping to capture those funds by use of a port security grant, federally funded port security grant, which we were unfortunately denied. Also, alternatively, looking for the foundation to support, they declined supporting it at this time. So ultimately, since there was a money issue, or a question of using the general fund reserve account, we would need board approval. Now, this went out for RFP. 3 responses came back. The lowest response was well under budget. However, they did not follow the instructions of the RFP and essentially gave us a recommendation for the exact same type of boat that we were seeking to replace. That boat did not, I can't explain it, but that boat did not meet our requirements. And again, we need to replace it. The next mid-level, the next more affordable came in, which came in at $104,356, which was almost $10,000 over our initial budgeted costs. That met our expectations. They followed the RFP to the letter. It is exactly the kind of craft we're looking for. The next highest, the third response to the bid came in at $155,538, which was way over budget. Now, as to exploration of what the closer of the two, that was from Brunswick Commercial and Government Products out of Edgewater, Florida. That explained, or the increase in price is parallel to what we're seeing in other instances with an increase overall from tariff increases, as well as it's a 2027 model, not a 2026 model, which we'd initially spec'd out. So that would account for it. So we will be seeking for an approval for that in amount not to exceed $104,306.
If I may, just one point that I want to highlight for the finance committee that we wanted to get across to you tonight is that this was not a CIP project that was planned to draw down general fund reserves. So this would be above and beyond what we budgeted to draw down fund reserves. But as Margaret pointed out earlier, we do have revenue surpluses already that are indicating that we will exceed our budgetary targets by as much as 700,000 at this point. We're 5 months in, so that's a good sign. And we wouldn't have brought this to you if we didn't think that we would be able to absorb this purchase, but the original budget had a corresponding revenue to make this purchase a net zero. But now it will be a drawdown.
And one additional point, sorry, that's cut you off, but the existing craft will be sold as surplus to offset some portion of the cost.
It is, so part of the increase is because of tariffs.
Well, there's, what we're seeing across the board is in other departments as well too, is the increase in tariffs, increasing costs from the.
Is there any way to contract sort of the tariff vaporizes down the road? We get rebated the money instead of just the manufacturer? I don't, and I'd be interested, I don't know, but we're starting to see this now. Can we contract, okay, we're paying extra because of the tariff. You manufacturer saying you have to pay this, but if you don't.
That can be explored, but I don't know that turnaround time is in a 5-month turnaround time from when we signed to when they deliver.
Oh, no, but you know, in theory, if we have a contract, and I don't know if this is even possible, this depends on government contracting law. But if we sign a contract that says part of your price is a tariff, and in a year and a half, you get the money back from the tariff, you pass it along to us. I mean, that doesn't seem ridiculous. I have no idea if it is ridiculous, but you know, I keep.
Let us take a look. I'm not sure that, I haven't seen a contract that has that yet. That doesn't mean they don't exist. So let us do a little bit of work on that.
I mean, it's become an issue. We
No,
know these tariffs,
absolutely.
they became illegal, and
Some of them did, yes.
the Uber one became illegal, and then the question is, so who's getting the money if the customers actually was passed through them?
And in fairness also too, we experienced it when we first went down the road with replacing the squad. We have seen across the board, as all municipalities have, a significant increase in manufacturing costs across the board. So that is also plays a significant role.
I think a question that we'll try to decipher a bit more is the impact tariffs or is the impact something else? Because I would tell you, I'm not sure where this boat is actually built. It's assembled obviously in Florida, but I'm not sure where all the pieces and parts are coming from. That may be difficult to ascertain, but we certainly can take a look and see if this is driven by manufacturing costs. I would tell you, I'm kind of surprised that it's only 10% over what we budgeted. I don't see that as dramatically out of whack considering what we were looking at. So I'm just saying that from the standpoint, I think the tariff impact is de minimis. It's probably a series of other things, but let us look into that. Yeah.
I of course have no idea, but if the seller says, oh, you're paying extra, not because of me, but because of this evil tariff, then okay.
To your point, President Rowan, I think it's a question we can ask. It's something we can try to negotiate for sure. You know, whether or not they'll agree to it is maybe a different thing.
You know, they
but-
might say, okay, it
it's
isn't really tariffs, I just, you know, but
I'll explore that and try to get it for private goods. No, they unfortunately don't give us, they don't give us an answer as to why, which I always like to seek and ask. So for the next time we apply for something,
Yeah.
However, Highland Park applied for the same grant the year prior, and they were successful in that, allowing them to purchase a much nicer boat. But I don't know what goes into the decision-making process. Unfortunately, I think there were a lot of disappointed municipalities that applied for similar grants because it was during the shutdown, which happened twice during the time span. So that may have been a factor.
Two more points. I wanted to talk about schedule changes and the CIP timeline. The first one is for the golf club protective netting proposal for the driving range that is currently out to bid and will be bringing it to the village board for approval in June. Also delayed is the Village Hall South entry renovation and fire bay driveway replacement. That has not yet gone out to bid. It should within the next couple of weeks, but we are wanting to do some final coordination with the Village Hall space needs analysis to make sure that everything we have spoken in makes sense as we answer the future as well. Any questions on CIP projects?
Then we'll invite Brian and Patrick, who'd like to.
And thank you guys for being here and sitting through all that.
Thank you. Hello, good evening. Thanks for having us out to present today.
Feel free to have a seat.
I am Patrick Trubman. I work at CTMA on the iPrime team, so I serve as the day-to-day contact for the village in their short-term investment portfolio. I'm joined today with Brian, who is representing the investment advisory service arm of the. I heard that we might have questions about pass bonds and arbitrage, so you guys would like to start there, we can start there, and then we'll let Brian go into the investment strategy and portfolio update.
Just to provide a little context, so Patrick, if Patrick needs to leave suddenly, he has a very pregnant wife at home.
Yes.
So we will give him some grace. But we do, as the committee will recall, we have two facets with PTMA in which we are invested. Essentially, the iPrime Fund, which is the local government investment pool that they have. They offer full arbitrage services, full collateralization deposits. And that is an allowable investment under our investment policy, which Brian will be touching on a little bit later. So these would be the progress reports related to the funds that we have deposited in the iPrime accounts. So those are outlined in the treasurer's report. And then Brian will be going over the 5-ish or so million that we have invested in longer term investments. So I just wanted to make sure that we understood the distinction there.
All right, so I just passed down the BPM reports for bonds that are outstanding or have outstanding arbitrage. So the top one is the 2023 alt revenue bonds. You can see on the right side in that portfolio arbitrage status right at the bottom, the arbitrage liability on that is going to be $108,000 or $108,092.67. And that is not due until the 5th year anniversary of the bond, so you won't have to pay that until 2028. The middle one is the 2023 golf course bonds. And then there's going to be an arbitrage liability of $79,534.73. And then finally, we have the 2025 bonds, which currently do not have any arbitrage liability. Questions?
One thing I just want to note is the figures that Patrick's quoting are potential arbitrage.
Correct,
Right?
yes.
So we do go through a process once all of the bond proceeds are expended in which we pull all of the invoices and we send those over to PTMA. They do a full analysis on the timing of it to see if this is the ultimate amount. They're going off of the timing of when we draw from the bank account to reimburse ourselves as we're spending the money down. We don't actually write checks from these accounts. So there is kind of a true up process to finalize the calculation at the end of it. So this, I just want to say that these numbers might change slightly and optimistically they might go down. That's my hope.
So are you saying if you actually went and spent money or paid from other funds, some big chunk of something, but then didn't reimburse yourself for a while, when you reconcile, the arbitrage clicks down a little?
Got it. That's a very good way to explain.
And at the end of the day, if there's any money that, if there's any amount owed in terms of an arbitrage rebate liability, it's because we made too much interest
Yes.
on the, on our proceeds while they were still sitting there for too long a period of time. So it's not like we're coming out of pocket, it's money that we've earned and are sitting in the account,
Correct. And if we
not
spend
drawing
it,
down from our other reserves or something.
yes, and if we spend it fast enough, we get to keep it.
Right.
But if you don't, if you have any type of delay in
Delay.
construction, which
You do.
in reality, there are, you have to pay it.
Yep. Okay.
And we do, as part of audit, estimate a portion of the bond proceeds where we will set that aside. We will book it on our ledger to make sure we don't spend those monies until this calculation is finalized, and then we have that money. So we're not trying to come up with $180,000 on that.
I can't imagine
Joe gets very excited.
I want to pay it back.
On our 2021 bond issue, we actually had an estimate of like $48,000 for an arbitrage payment. And we went through and pulled all the invoices and provided all that information to PTMA and actually came out paying it for the road arbitrage. Because it was all based on the time that was causing the issue that the arbitrage was there. So potentially, you know, it can definitely reduce, which is good.
If the timing is perfect, so we don't have this arbitrage, or so we don't have to pay anything, are we actually saving any money, or no, we're just avoiding making the extra money that we have to turn over?
We're getting a windfall from the interest that we've earned over the interest we're paying.
So in that case, this is an LRAD treatment question. Should we try to build into our contracts, contractor, here's when you're supposed to get this done, and if you don't.
Well, that is something we're working on, but I don't think that always ties in because it ties to when we actually issue. So we're not always ready to spend those dollars immediately. So some of it's on us, some of it may be on a contractor. That the concept of, you know, the bait or the carrot or the stick is something that we're working on in terms of all of our capital project contracts.
You know, we could have, of course, you could have liquidated damages too.
Right.
But I'm just, you know, this is.
Some of it is within control, some of it is without. And I think that's, the goal is always to get the projects done as quickly as we can. Some of it is just simply how quickly we can get a project out on the street, how quickly that project can be let, how quickly construction can actually begin. We are always of the mind that we don't want the dollars in the bank before we need them. I would just say, though, we talk about arbitrage like it's a bad thing. We're actually not losing anything. We're just not gaining the extra value. So it doesn't cost us any money. It just perhaps gives us less new money. So it's actually a good.
I'm just thinking it was in a circumstance when we're not getting as much as we would otherwise get, and if it's the responsibility of our contractor.
It's a factor in the cost of delay, for sure. Absolutely.
Yes, and so the question, and you know, you're right, include that in the contract, and maybe we alternatively have liquidated damages, but if this is more, okay, just something to talk to our lawyers about, because they might be able to negotiate this.
And it depends on the issue. You know, we had an issue, we issued $3 million for a sewer project on Green Bay. That money was spent within, I think, 3 months of the bond issue. We spent that down and it was gone. Compare and contrast that to the golf bond issue where we got caught up with the Forest Preserve District and all kinds of things that we weren't anticipating. It can be tricky sometimes. Any other questions on the arbitrage or the process?
All right, well, really appreciate all the discussion here. I mean, we're a firm that's all about serving public entities. That's basically our entire business. You know, the investing operating dollars and operating reserves is, you know, certainly an important part of that. But I think the most fun part of it is seeing the project, seeing the golf course that's getting built, knowing a library is being built that'll serve the community for 100 years. You know, we hope, right? So really cool stuff, and you know, just glad to be a part of it. So, you know, with that, speaking of our company, we did add a letter since last time we met you all. We are now PTMA, slightly different branding here. So we brought together two different companies, PMA and PTA. through lots of creativity, we came up with PPMA. The debate over which letter would be first was, robust. But, in all seriousness, two firms doing very similar work, extremely little geographic overlap. We're PMA, historically a firm based in Naperville, Illinois, largely serving the Midwest, I would describe it as, whereas PTA based out of Denver, kind of the Mountain West, as well as kind of more along the East Coast from New York down to Florida. So not a lot of overlap, but bringing together a bigger, stronger team, more investment resources. Ultimately, though, the team that's serving the village of Glencoe is the same team that's been serving the village. Our processes, the PMA kind of side of things is really leading the way on what we call separately managed accounts. So an account that's specifically serving one entity. So, the more things change, the more they stay the same sometimes is an expression. I think in some respects it's true here. In some respects, though, we definitely are a larger, more robust firm, more controls, more, all of the good things that you want out of your financial services provider. Just a couple of notes, highly regulated business. I just want to highlight that Patrick already spoke to. He works on the PMA Securities. That's our registered broker dealer, also a registered municipal advisor. In that role of fiduciary duty, whenever you're touching bond proceeds, to put the client's interests first. My role is PMA Asset Management, our registered investment advisor, also a fiduciary duty to put the client's interest first. So again, this is what we do, and we really, I think, to a person, enjoy doing that. We in total are responsible for over $150 billion in assets around the country. So it's a big company, but we're also very much so a local company that is here to serve all of the communities that we work with. I've shared this exact same slide, and I did just want to highlight that this process that starts with research, thinking about expected returns across sectors, building a strategy that works for our clients, getting best execution in the market and measuring those results. This is the same chart that I showed you when we put out the RFP response, probably, and we've been working on the same process. We really do live and breathe this process every day, and it's something that is been maintained through the merger process here.
It's like the 30-second answer of anything that's changed in this process in the last couple of years.
I think the biggest piece is that the other firm had a larger presence in the local government investment pool space, so funds like iPrime. So their chief investment officer, his new title is Chief Investment Officer of Local Government Investment Pools. So that sort of part of the business has gotten the emphasis on managing money of the fund. So when we think about iPrime and the assets that are in the fund, the money market fund itself, they brought a lot of resources, PTA being that they brought a lot of resources, a lot of strength, deeper bench on credit. We're doing very good work on all this. I never want that to be diminished, but I think they brought certainly a larger team to that part of the business. Whereas I think we brought greater strength on the separately managed account side. So that's why you see kind of the same process and on this side of the business.
Yeah, we've sort of broken, fix it.
Yeah, that's probably the biggest change. So market update. I know you've already been talking about this a fair amount. I think if you don't start with the price, gas and oil, you're kind of missing the point here. We are well back above $100 a barrel in oil here. As I looked before the meeting, it was a little above $108 per barrel. We had seen some serious improvement with the ceasefire. The latest headline I've caught, and everybody, I'm no expert in, this conflict, I should, point out, we all kind of read the papers on this, but, the ceasefire on life support, it does feel, at least increasingly to me, that some sort of escalation to de-escalate feels like at least what the market is pricing in. So you see that in the price of oil, you see that in the bond market. And we're even starting to see a little bit of that in the stock market here. Although the stock market's been on a very good run here the last couple of months, to say the absolute least. So I think what our focus as prudent risk managers is really thinking about how long do prices stay here. And I think as we get into the third quarter, summer driving season, just the extended period of time, that is where we start worrying that the strain on spending, the pressure on inflation becomes more significant. I will say that it does not feel as though we're going to see a repeat performance of what we saw post-pandemic on inflation, in part because the labor market is it feels like it's in a different spot than we were at there. So it's having, this inflation pass through labor, when you really saw labor kind of stand up and get paid significantly more, which was probably needed. And some catch up on that front. Painful for those paying the bills, I understand. But it doesn't feel like we're going to repeat that piece of this. So, obviously, no crystal ball here. We continue to watch all of it. These things can play out in unexpected ways. Ultimately, this is why we build diversified, high-quality portfolios, so that we can, withstand the unexpected. But that's kind of how we're thinking about the price of oil and this conflict at this point. Good news is the consumer remains employed and the consumer continues to spend. And as a general rule, an employed, U.S. Citizen is generally a spending U.S. citizen. That's continued to see. We saw a fairly surprisingly good jobs report in the month of April, 115,000 jobs added, unemployment at 4.3%. And we might recall there's been some, three handles on that unemployment rate in the not too far past. But that was really very unusual. You don't see that very often. I think for kind of quote normal-ish employment times, around 4.3% is pretty typical, pretty healthy. So we feel good about that. Auto and credit card delinquencies, people did take their stimulus money and pay down a lot of debt. They got caught up on their debt. So we've seen some normalization in that in the last 2 or 3 years here. But if you look at this is a 20-year chart. So you really have to look at the very, very end of that chart. But you can see it was actually kind of starting to tail down. So we flattened out. So again, the consumer has been resilient. Certainly, as I mentioned a moment ago, the longer oil remains high, does that start to weaken here? But I think as long as the jobs picture holds up, that's going to be really an important thing to watch. Corporate, perspective, debt is low. So just like I was saying on the consumer side, you've got, pretty strong fiscal responsibility in the corporate perspective. A company with less debt has greater financial flexibility. So that's a good thing. And we certainly see a strong earnings picture. NVIDIA is going to be reporting earnings tomorrow. Certainly the big tech names drive a lot of the headlines, but I do want to emphasize that there's been a lot of breadth. If you agree with that, but pretty strong breadth in terms of the quality of earnings that we're seeing across the market. That doesn't mean to a company, of course, but as you look at your large S&P 500 type names, first quarter earnings is looking quite good here. So feel good about the corporate fundamentals, and ultimately we are fundamental investors. We're looking at the quality of the investments that the companies that we're investing in, or any type of security that we're investing in. And that's how we're making our investment decisions. So looking forward, we think the Fed remains on hold. Obviously we're all familiar with the political pressures here. A new Fed chairman was just approved by the Senate last week. He'll be chair for the next Fed meeting here in the middle of June. We will still see Jay Powell on the board. So that could be an interesting dynamic for sure. Things to watch here. The Fed dot plots. If you're familiar with this idea of the dot plot, oftentimes you see it on a Bloomberg screen. It's these yellow dots. It's where each Fed member believes rates are going in the future. The bias there is a trend down. If you read kind of between the lines on the last press statement after the after the Fed meeting. There's a tiny little bias towards down, and we all know the political pressure there as well. So I think the Fed wants to cut rates. I think they're going to be very, very challenged to do so in the next 12 months here. Even with that political pressure, tend to believe you don't see a rate cut. And that's increasingly priced into markets. That's a big part of why we see bond rates moving up across the curve. So, one of the other themes here, volatility is going to remain. We're going to continue to see these ups and downs. But again, we really like the strong corporate fundamentals, and markets are behaving quite well through this. We see good liquidity. We see, if you want to look at the financial conditions index, or all of these different indicators of liquidity in the market, it's good. So things to watch. There's always headlines. There's always risks. But we actually do feel pretty good about where markets are, particularly for really, high quality investors, as is required under state statute, under the diligence investment policy. So before I turn to the portfolio, I will pause there for any market questions. All right, if there's a win. Was that wrong? Did I say that out loud?
That's okay.
Yes, yes, you're so good.
And it's okay. Are you expecting us to be like not win?
Say it, sir.
Yeah. So the portfolio, once again, extremely high quality, extremely well diversified. Is a 1 to 5 year strategy. I'll say this, I guess, maybe on the next slide, but doesn't mean the whole portfolio is invested out 5 years. It is a laddered portfolio, Trust treasuries, agency mortgage-backed securities, corporate securities, being some of those larger segments. Again, we're always measuring ourselves. We're comparing ourselves to a treasury benchmark, treasury and agency benchmark. Got a 14 basis point yield advantage over that benchmark. The duration right in line with our benchmark, and the quality right in line as well. So, I think, lots of good things to talk about there. As I mentioned, here's a look. Again, that duration very much in line. So not just the average duration of 2.5 years. This is basically the shape. A lot of debt gets issued in the 1 to 2, 2 to 3 year type buckets. So that's why those buckets are larger. It's not that that's necessarily a tactical decision. There's maybe some minor things happening tactically around this, but that this is the shape of the benchmark. So there's a significant amount of funds that are getting reinvested on a regular basis. So what's changed here? Since we've got started, and specifically over the past year, I will say that the treasury portion of the portfolio has moved down from about 45 to a little under 40% of the portfolio. At the same time, corporates increased by about that same 6%, from 15 up to about 21%. So what we were seeing a year ago was extremely tight corporate spreads. It just didn't make a lot of sense to be investing significantly into that sector, recognizing spreads could widen out. That puts downward price pressure on bonds. Plus, you kind of want that ability, given there is a limit in terms of how much corporates are allowed under statute. We don't want to use up kind of all of that, recognizing that when spreads widen, we may want to pick up some more of those. So for high quality investors, a little bit of volatility in the market where we can start to get paid a little bit better, quite frankly, for buying those corporates. That's something that we've taken advantage of here recently. Price slowing that down a little bit. I think the risks are rising here at this point, so we don't want too much of risk of those spreads continuing to widen out here. So I think we're kind of, holding steady at this level, but we certainly do have room between, the 20 or so percent corporate that we're at. Sorry, I need to go ahead. The 20% corporate that we're at, and the 3% that we could increase this to. So that's the biggest. Yeah, it's a touchy button. But yeah, so that's the biggest change, a shift from treasuries to corporates. Net and gross returns looking really good here. I mean, trailing year returns of around 3.5%, looking pretty good in this market. And most importantly, our job is to exceed the benchmark, and we're exceeding it by 50 basis points. So I mentioned a moment ago, our yield advantage is 14 basis points, but our return is 50. So there's a lot of things we're doing other than just, we do get this question, well, it's a treasury benchmark, you do have some corporates, so all very high quality securities. Continue to think that a treasury portfolio is a good representation. There is no benchmark of Illinois statute allowable investment. So treasury is a good starting point. We recognize, yes, there's going to be a spread there. But what else are we doing? So some of the more active components of our strategy, and given we're mostly buying and holding these securities, we're by no means day trading this portfolio. It's not heavily traded. But if you look in the past year, we have done quite a bit more selling than typically. Part of that has been as bonds start moving inside of 1 year, we've been selling more of those, extending back out. We want to make sure we're keeping that duration up. We've also been, with a steeper yield curve, able to take advantage of what's called rolling down the yield curve. So as a bond moves closer to maturity, that spread tightens up, the yield moves down. That means the price goes up, so that can create an opportunity. And again, with volatility in markets, we really want to keep that duration, very close to our benchmark. So being a little bit more active in the past year, I think you put all three of those together, that's how we've really been able to drive some nice excess returns over the benchmark here in the past year. So, definitely very, very pleased with the performance. I think it was a couple of years ago, one of the requests was just to share some of the names. Obviously, page full of treasury securities laddered out across the curve. But as you look, and then we have some agency mortgage-backed securities is another important component of the portfolio. As you move, though, into the corporate piece, just want to highlight a couple of names. Names like Amazon and Citibank and Caterpillar and John Deere and Pepsi, Visa, to name a few. So these are names and you recognize. Companies are trading in the S&P 500, the strong earnings, the strong fundamentals that we're speaking to. We're doing the research on each one of these. We're not relying certainly we look to what S&P and Moody's and Fitch says on credit quality, but we're doing our own research there as well. So the last thing, I know we've covered a lot of ground here, that I did want to bring back up was last year around this time, there was some discussion around what else could we be doing to enhance income, enhance returns in the portfolio. We talked about the potential of extending this out to a 1 to 10 year portfolio, kind of the risk reward piece on that. We're seeing that with the move up in long-term rates here. My advice was for a portfolio of this size, this nature, I thought the 1 to 5 year made sense. We talked about maybe adding triple Bs rated, so a little still investment grade, but less than the single A. That's something you could do under home rule. I don't want to put words in anybody's mouth, but I don't think there wasn't a lot of interest in that was our perception at the time. But one piece I did want to bring up is that state statute has been consistently increasing what municipalities can do with respect to corporates. So if we went back like 10 years or 15 years ago, it's 180-day commercial paper. And then they went to 270 days. And then they went to 3 years. Most recently, they've gone to 10 years under state statute for single A rated and better names. So we would recommend that the village update its investment policy to allow that. From a practical standpoint, this is still a 1 to 5 year strategy. So really what this is opening up is those corporates between 3 and 5 years as a practical matter. So we think that would be something that's beneficial to the village. It's very much in line with what other municipalities around the state that have an investment advisor managing the funds are doing. So wanted to get some feedback from you all on that recommendation.
Sounds like a good idea.
Why wouldn't we do the triple Bs?
I mean, we certainly could. That was one of the things.
When you're seeing other people doing it?
A few, yes. I will say it's not.
I was seeing you doing it on I should mention credit risk because you're not taking duration risk. So clearly you're doing your homework on security selection. So it seems like you have the skill set for it. I mean, we could add it in that, because as long as Nikki's changing the policy, Doesn't mean you have to do anything. We just put it permissioned in our policy. And we could decide to do it at a later date and tell them, you can go down.
Right, well, and it depends on what the spreads are at the time they're.
This is just an interesting bond market, and they're pretty good at this clearly, right? I mean, I think those numbers, you probably saw yourself, show us a great number. So.
If you're interested in that, I would also add in the one that I didn't mention from last year is asset-backed securities. It's a generally credit card, auto loans. They're in the AAA quality.
We're taking the
sector.
tranches that are in the triple.
AAA, yeah. And we are exclusively, we look through to the underlying, so we're not buying subprime deals that have through structure gotten themselves to AAA. We're buying prime underlying loans that are structured into AAA. So you have multiple layers. You have a good underlying, and then plus you have the structure in place. So that is another sector that we like.
You work with Nikki and rebuying the policy, so we've got limits, right? 0 to 10. It'd probably be off the bench. It should be different than the benchmark. Should be taken out of benchmark, risk there. And I think I'm suggesting we would add it, and then you don't have to do anything with it. And then you have to write the policy. If you tell us if you come back in a quarter and say there's opportunity, then we could greenlight that.
At the end of the day, the way I look at it is we are not taking full advantage of your expertise.
Yeah.
And
This is really the area of the market where there is just so many securities and opportunity. If you have a team with a deep bench, like that's not. Question?
You're a step ahead of me. I
Sorry.
want to note, this is great. It's a perfect segue because I wanted to hear what you were all thinking. And if you're supportive of the duration increase, triple B securities and the credit backed securities, then we can update the investment policy, bring it back next month, and you can approve it, and then we can go from there.
Yes, I love that. Just because when the market crashed and burned in 2008. I just want to make sure that the decision we're making now is not, everything looks great, and so it's then all of a sudden crash and burn. I want to make what Joe said makes sense, but I want to make sure we're not heading towards.
Yeah, excellent question. And that question comes up on asset backs very often. One thing I want to highlight is that asset backed securities I'm referring to performed exceptionally well through the financial crisis, through the pandemic. These are not the bad three-letter, acronyms from the financial crisis that were really more real estate related. And again, to the extent that we're buying these, we're looking through to the underlying borrowers. So we're not investing in subprime borrowers. That's never been our. So, anything can happen. Corporate bonds can go bad, asset-backed securities can go bad, but you diversify, you monitor these things, you stay on top of them. It's always risk mitigation. This is how you pick up some additional yield. And we've had, lots of success in that, but I never want to. That's a very valid point.
Joe's point, we should be taking advantage of you. That's a good point. I just don't want us to, irrationally exuberance ourselves into something that crashes and burns, because no one will be sympathetic.
I'm with you. Again, I don't think this is the riskiest part of the market, and we have a really low duration. And you have a big credit research team. I think if it's in state statute, we should add it. Doesn't mean that we have to have you do anything with it yet, right? We talked about opportunities.
And just to be super clear, the 10-year corporates is in state statute. The only way that you're allowed to do the triple B corporates and the asset-backed securities is by being a home rule community. Gives you greater authority to act beyond what's allowed under state statute. So I just want that, that disclosure.
Is there a state statute that covers what home rules can do?
To my knowledge, it is quite open-ended.
It's very explicit for non-home rule.
Yes.
Maybe there's some language in the policy we can add to protect us a little bit better, maybe to Howard's point, versus just adding it.
Yeah, you
Maybe
said
there's like,
limits.
set some limits or some
Yes.
protections in place.
Yeah.
See.
I like that.
Yeah, you wouldn't want to be, 80% invested in even though
Yes.
the car loan. I
Yes.
don't care what the rating is.
Yeah.
Yes.
Yep.
So we will make some edits to policy and we'll bring that in June. Any other questions? Or July?
A lot of June is all.
It's true, the finance committee is fun. We might have a little bit more time, that's okay.
All right.
Thank you.
Any other questions? Gentlemen, thank you. Thank you for helping us achieve the results that you have. It's much appreciated.
Likewise.
Getting home to your pregnant wife, but you can't speed with them here.
I mean, you can't.
You see, that means I can speak.
Leading ahead of him is no guarantee the way he drives, but.
Also fair.
It used to be true, we would say, watch out for Northfield.
No, that's still true. That's still true.
Yeah, watch out for watch out for Willow Road.
All right, is there any other business? Anyone? Hearing none, seeing none, can I get a motion to adjourn? Motion to adjourn. All in favor? Aye. We are adjourned, thank you.